Hey everyone, welcome back. Ready to dive into a new topic?
Always.
Great. Today we're going to be talking about equity crowdfunding.
Cool.
It's been getting a lot of buzz lately, and for good reason.
Yeah, it seems like people are really starting to see its potential.
Exactly. But we're going to go beyond the hype, really break it down and see what's really going on.
That's what we do here.
So, to kick things off, what is equity crowdfunding? Why should people even care about it?
Well, at its core, equity crowdfunding is all about changing the way businesses get funded.
Okay.
It's about shifting power away from the traditional gatekeepers, the big banks, the venture capitalists,
I like the sound of that already.
and putting it directly in the hands of individuals.
So instead of just buying a product, you can actually invest in the company behind it.
That's the idea. It's like becoming a micro venture capitalist, supporting businesses you believe in at the ground level.
And in return, you get a piece of the pie if they succeed.
Yeah, you become a part owner with a real stake in their growth. I can see why people are excited about this. It's like a much more direct way to support innovation, to be a part of something you believe in.
Exactly. And it opens up opportunities for smaller businesses, businesses with great ideas, who maybe wouldn't have gotten a second look from those traditional funding sources.
Okay, so it's democratizing in a way.
Exactly.
But let's get into the nitty-gritty. I mean, can we really talk about efficient allocation of capital when it comes to something as, well, unpredictable as crowdfunding?
That's a great question. And you've hit on a key point. We can't just throw around the word efficient without really understanding what it means in this context.
Right, because in theory, crowdfunding sounds amazing, but we need to see if it actually lives up to its promise.
That's where the research comes in. The paper we're looking at today dives deep into this question of efficiency.
So when we talk about efficiency in this context, what are we really talking about?
We're talking about something called Pareto efficiency.
Okay, I'm going to be honest. That sounds a little intimidating.
Don't worry, it's not as complicated as it sounds.
I hope not.
Basically, Pareto efficiency means that resources, in this case capital, are distributed in a way that makes at least one person better off without making anyone else worse off.
So like a win-win situation.
Exactly. It's like finding that sweet spot where everyone involved benefits as much as possible.
Okay, I'm following you. So in the context of crowdfunding, would we say that's when, let's say, a promising startup gets the funding it needs to succeed?
Yes.
And at the same time, the investors who believed in that startup see a return on their investment.
Exactly. And what the research found is that under certain conditions, equity crowdfunding can actually lead to this kind of Pareto efficient outcome.
Really? That's promising.
Yeah, it is. It suggests that this isn't just some pie-in-the-sky idea. There's real potential here for a more efficient, more democratic system of funding.
But I'm guessing it's not all smooth sailing, right?
You're right about that. There are some real-world challenges that we need to consider.
Like what?
Well, one of the biggest ones is the issue of wealth inequality.
Ah, yes. The elephant in the room.
Because for equity crowdfunding to truly live up to its potential, to be this engine of efficient allocation, it needs to work for everyone, not just those with deep pockets.
That's a critical point because if only the wealthy can participate in a meaningful way, it doesn't really change the power dynamics all that much, does it?
Exactly.
It just becomes another system that reinforces existing inequalities.
Unfortunately.
Oh.
And that's something that the research really grapples with, this tension between the potential of crowdfunding and the very real constraints posed by wealth disparities.
So it's not a silver bullet.
It's never that simple, is it?
I guess not, but it's definitely something worth exploring further.
Absolutely. There's a lot to unpack here.
So where do we go from here? I mean, we've talked about the ideal, this vision of efficient allocation, but we've also acknowledged the real world challenges.
Right. And one of the things the research explores is how these challenges actually play out in the context of specific crowdfunding scenarios.
Okay, so let's get specific. What kind of scenarios are we talking about?
Well, one factor they look at is the impact of what's called sequential investment.
Sequential investment.
Yeah, it's basically the idea that people's investment decisions can be influenced by seeing how much others have already invested in a project.
Oh, right, like the whole herd mentality thing.
Exactly. It's like social proof, but in the world of finance.
And how does that impact efficiency?
Well, what's interesting is that even though it might seem like this kind of behavior could exacerbate wealth inequality.
Because if you see someone with a lot of money investing heavily in something, you might be more likely to follow their lead, even if you can't afford to invest as much.
Right. But what the research found is that, counterintuitively, sequential investment can actually increase efficiency in some cases.
Really? How so?
Because those early investment decisions, even if they're driven by a variety of factors, can provide valuable information to everyone else. It's like a built-in feedback loop.
So even if those early investors have more money to throw around, their decisions can still benefit those who come in later with smaller investments.
Precisely. It's like they're inadvertently helping to separate the wheat from the chaff. Their investments, and potentially their successes or failures, can provide valuable insights for everyone else.
That's fascinating. So it's not just about how much money you have, but also about when you decide to invest and the information you have available to you at that time.
Exactly. It adds a whole other layer of complexity to the equation. And speaking of complexity, the research also digs into how the nature of the product or company being funded can influence the efficiency of crowdfunding.
Okay, I'm intrigued. Tell me more about this product-specific aspect.
Sure. Think about it this way. Imagine you have two companies, both seeking funding through crowdfunding. One is developing a new software app, and the other is manufacturing a physical product, like a new type of electric scooter.
Okay, I see where you're going with this. One is purely digital, while the other involves physical production, supply chains, all that jazz.
Exactly. And in the research, they refer to these different scenarios as production technologies. Essentially, it's about how the relationship between investment and output can vary depending on the nature of what's being produced.
So for the software company, it might be a much more straightforward equation. More money invested directly translates into more developers, faster development cycles, quicker time to market.
Right. But with the scooter company, there might be limiting factors. Even if they have a ton of money, they might not be able to ramp up production as quickly due to things like manufacturing capacity or supply chain constraints.
So even with all the enthusiasm and investment in the world, they might hit a ceiling in terms of how quickly they can scale.
Exactly. And that inherent difference in their production technology can impact how efficiently crowdfunding actually allocates capital.
It's like some products are just naturally better suited for this kind of funding model than others.
That's one way to look at it. And it highlights the importance of understanding these nuances, both for investors and for entrepreneurs seeking funding. Now, there's one more piece of the puzzle I want to touch on, and that's the role of larger, more strategic investors in the crowdfunding landscape.
Okay, this is interesting because earlier we were talking about how wealth inequality can be a barrier to truly efficient crowdfunding. Are you saying that these bigger players with their deeper pockets could actually be a good thing?
It's complicated,
Yeah.
and that's what makes it so fascinating. On the one hand, their involvement could potentially help to mitigate some of the challenges posed by wealth disparities.
Okay, I see where you're going with this. They could act as a sort of equalizer, using their resources and expertise to identify and support promising projects that might otherwise fly under the radar.
Exactly. Think about it. A large market research firm, for example, with its access to data and analytical tools, might be able to spot trends and opportunities in the crowdfunding space that a smaller individual investor might miss.
So they could act as a kind of amplifier, bringing attention and resources to projects that align with broader market demand, regardless of whether those projects are getting a lot of initial traction from smaller investors.
Precisely. But, and this is a big but, there's always the potential for this kind of influence to be misused.
Right, because their involvement could also skew the market in a different direction, potentially creating a self-fulfilling prophecy where their investment decisions disproportionately influence everyone else.
Exactly. And that's a risk that the research acknowledges. Just because someone has a lot of money to invest doesn't mean they always know best.
It's like that saying, money doesn't buy taste. Or in this case, money doesn't always equal accurate market prediction.
Exactly. And it raises some interesting questions about how to balance the potential benefits of having these larger players involved in crowdfunding with the need to ensure that it remains a truly democratic and accessible system.
It's a tightrope walk, for sure. And speaking of navigating tricky terrain, I'm curious to know how all of this stacks up against the more traditional players in the game, the big banks, the venture capitalists, the ones who've been calling the shots in the financial world for decades.
Right. Can a system driven by the collective wisdom and, let's be honest, the wallets of the crowd really compete with these financial behemoths?
So we've got this upstart, this scrappy contender in the ring with some real heavyweights. Does crowdfunding stand a chance?
Well, that's the million-dollar question, isn't it? But here's the thing. Crowdfunding comes with a few secret weapons, things those big institutions just can't replicate.
Okay, I'm listening. What kind of secret weapons are we talking about here?
Well, think about how venture capitalists and banks typically make their decisions. They pore over spreadsheets, market analyses, all that.
They try to predict the future, basically.
Exactly. And while that can be effective, it's also inherently limited. They're relying on data that's already been collected, interpretations that have already been made.
Whereas crowdfunding taps into something much more immediate, much more visceral.
Exactly. With crowdfunding, you're not relying on some analyst's interpretation of consumer sentiment. You're seeing it firsthand, in real time.
It's like the difference between reading a weather forecast and actually sticking your head out the window to see if it's raining.
Perfect analogy. Crowdfunding gives you that direct feedback loop, that unfiltered view of what people are actually willing to put their money behind.
Which, when you think about it, is incredibly valuable information.
It's pure gold.
Yeah.
And it's something that traditional institutions just can't match, no matter how sophisticated their algorithms get.
So in a way, crowdfunding is almost like this giant decentralized market research experiment.
That's a great way to put it. It's like crowdsourcing the future of business.
But if it's so powerful, wouldn't those big players want to get in on the action? I mean, wouldn't they try to dominate the crowdfunding space just like they've dominated so many other areas of finance?
Here's the thing. Those traditional players, they thrive on a certain kind of market inefficiency. They do best when they have an information advantage, when they know something that others don't.
So if crowdfunding is working as intended, leveling the playing field, making information more transparent, it actually becomes less appealing to them.
In a way, yes. If capital is already being allocated effectively based on real-time demand and a diverse range of perspectives, there's less room for them to swoop in and exploit those inefficiencies.
It's like they need a bit of fog, a bit of confusion to really work their magic.
That's a very poetic way to put it. But you're right, crowdfunding has the potential to disrupt those traditional power dynamics, not by directly attacking those institutions, but by potentially making their existing models less relevant, less profitable.
That's fascinating. So as we wrap up this deep dive into the world of equity crowdfunding, what's the big takeaway for our listeners? What's the one thing you hope they walk away thinking about?
I think the key takeaway here is that equity crowdfunding is more than just a new way to fund businesses. It's a potential paradigm shift, a way to reimagine the relationship between businesses, investors, and consumers.
It's about empowering individuals to directly shape the market, to support the ideas they believe in, and to potentially reap the rewards of their investment, both financially and in terms of seeing those ideas come to life.
Exactly. But it's also important to remember that it's not a utopia. There are challenges, there are complexities, and there are real-world constraints that need to be addressed.
It's about being informed, being engaged, and understanding both the potential and the pitfalls of this evolving landscape.
Absolutely. Knowledge is power, as they say.
And on that note, we want to thank you for joining us on this deep dive into the world of equity crowdfunding. Keep asking questions, keep exploring, and until next time, stay curious.